Good afternoon, everyone, and thanks for joining us. I'm Phil Bryant, and I head up our financial services team. And I'm here today with my colleague, Alistair Kemp, and he heads up our corporate planning team. Between us, we spend a lot of our time helping families think about inheritance tax, succession planning, and how to pass wealth on in a controlled, tax-efficient way. Inheritance tax might seem fairly familiar. The rules haven't changed dramatically, but in practice, a lot has shifted. Frozen allowances, rising property and investment values, pensions, unfortunately, coming into scope from April 2027, and increasing complexity mean more estates are now exposed than people often realise. So today, we want to give you a clear picture of the landscape, talk through the tools people actually use, and importantly, show how these tools work together rather than in isolation. This isn't about individual solutions. IHT rarely allows a silver bullet approach. It's more about spotting where risks appear, understanding where opportunities are, and where they're often missed, and why starting early and taking a coordinated approach really makes a significant difference. So today we'll walk through a range of solutions from the more simple options, which are often the most effective, through to more sophisticated and bespoke planning tools that can actually deliver immediate value reductions for larger estates. I'll pass over to Alistair to look at recent budget and legislative changes.
Thanks for the introduction, Phil. So firstly, let's just set the scene with some recent updates to the IHT landscape. Firstly, the nil rate band remains frozen at 325k, a level it has actually been stuck at since 2009 and is now confirmed to remain frozen at that level until 2031. Similarly, the residence nil rate band stays frozen at 175k for the same period. So as a result, the often quoted £1 million IHT allowance for married couples or civil partners, that continues to apply, but crucially this just has not increased in line with inflation or house price growth, so its real value has been steadily eroded over time. Second, following extensive debate and strong public reaction, as to be said, particularly from the farming community, the proposed changes to business property relief and agricultural property relief have been softened. The threshold has been increased from the originally planned £1 million to £2.5 million, meaning qualifying business and agricultural assets can now benefit from 100% relief up to a threshold of £2.5 million, with a 20% IHT rate effectively applying above that level. This broadly applies to trading businesses and unquoted company shares rather than investment-based activities or property holding structures. This also means, crucially, that business relief qualifying investments, which Phil especially is an expert in advising on, now feels a significant part of any IHT planning. So do speak to us if that's of interest. A major change to flag also is pensions. So from the 6th of April 2027, unused pension funds and death benefits will be brought into an individual's estate for IHT purposes. It removes their long-standing exempt status, and it really represents quite a significant shift, as pensions have historically been a bit of a safe harbour and a cornerstone of IHT planning, as well as being the natural incentive for long-term retirement saving. Now we need to think about unused or undrawn down on funds upon death. And finally, it's worth just mentioning that although there's been no immediate reform to lifetime gifting, this area remains an area of ongoing discussion and potential future change. Don't want to speculate, but it's still worth flagging that lifetime gifting, to the extent it's available and unrestricted, relatively speaking, as it is now, is definitely worth considering, which is something we'll look at in a bit more detail. Overall, the theme here is that fiscal drag, reduced planning headroom, and a continued tightening, really, of the IHT net. Next, I'd like to touch on will planning and lifetime gifting, as we were talking about just now, with the overarching aim of both of those things being to successfully use IHT reliefs to the fullest possible extent, while gradually reducing the value of one's estate during lifetime, but crucially without jeopardizing access to funds needed for retirement or in later life. Effective will planning ensures that allowances and reliefs aren't wasted, and can also incorporate trust planning on death where appropriate. A key point to emphasise is that both the nil rate band and the residence nil rate band are transferable between spouses, and following recent government clarification, the same now applies to the business property relief and agricultural property relief thresholds we were just talking about. This means the long established approach of leaving assets to a surviving spouse and then that surviving spouse leaving assets to descendants without losing any such reliefs thankfully still holds true. We're aware, unfortunately, of some clients who will have already amended their wills during the period of uncertainty when it certainly appeared that business property relief and agricultural property relief might not be transferable, but such planning can now be undone. Thankfully, it's a little bit simpler. In terms of lifetime gifts, these can be an effective way of reducing one's taxable estate, but in practice, we still see reliefs and exemptions underused. Gifts to individuals are generally potentially exempt transfers, meaning they fall outside the estate after 7 years of survival. By contrast, gifts into trusts or to companies are usually chargeable lifetime transfers, potentially triggering an entry charge effectively of 20% above the nil rate band, and indeed above any applicable business property relief or APR thresholds. It's also vital to consider capital gains tax. For CGT purposes, gifts of most assets other than cash in your main residence are treated as being made at market value, which can result in an immediate CGT liability, which will need to be funded and managed. Finally, care must be taken to avoid the gift with reservation of benefit rules. The classic example of this that people always think of is gifting your home and continuing to live in it rent-free. But the principle is actually much broader. Essentially, any asset that you gift away, but where you continue to enjoy the benefit after gifting it, that falls within the gift with reservation of benefit rules, and which essentially mean that the value of such an asset is brought straight back into your estate as if you hadn't given it away. We'll cover trusts in more detail, but they remain an important consideration not just for tax efficiency, but also for asset protection and control as part of wider estate planning. So Phil will take us through that in a little bit more detail.
Thank you, Alistair. Appreciate that. So this is life insurance in IHT planning. Life insurance often comes into the conversation a little bit later than it potentially should. So let's try and think about that a little bit differently. The key point here is that insurance doesn't reduce inheritance tax. It doesn't shrink the estate or change the calculation. What it does do is deal with a very practical problem, and that's the provision of cash flow. So many estates are traditionally asset rich, but can be cash poor. Property, businesses or investment portfolios often make up most of the estate, and selling these assets quickly or even at all can be challenging. So without planning, beneficiaries can be forced into sales at exactly the wrong time. So a life policy that's written into a trust provides a clean pool of cash that sits outside of the estate. So that means that IHT can be paid promptly, assets remain intact, and executors have far more flexibility. It's a strategy that is also very useful when it comes to lifetime gifting. So when someone gives a significant gift, the tax position doesn't disappear overnight. The gift only fully falls outside of the estate after a 7-year period. And during that period, there is still a potential tax exposure. So a specific life policy plan, it's actually called a gift inter vivos policy, will address that. So the cover typically reduces over time following the tapering tax liability rather than providing a fixed lump sum. So just for clarity, the tapering rules do not reduce the value of the gift, rather the level of IHT liability that's applicable, and full liability for the first 3 years, and then a reduction from years 3 to 7, becoming 0 at the end of the 7th year. So this type of protection gives confidence to make gifts earlier, knowing that any potential tax during that 7-year period is covered. Beneficiaries won't be left scrambling to find cash. Like other life policies, these are usually written into a trust, so the proceeds will sit formally outside of the estate and they're available quickly if needed. They don't need to go through the probate process. Additionally, if you have a limited company, it may be possible to use that company to fund the premiums in a tax efficient way. So the key point here is that this strategy, it doesn't change the tax rules. It manages risk while assets transition. Used alongside a gifting strategy, it makes planning more robust and less dependent on timing. So in short, insurance rarely works completely successfully on its own, but is often a vital supporting piece of a broader inheritance tax plan. Alistair, I'll pass back, and Alistair will look at trust planning, why and when.
Thanks, Phil. So Phil will talk us through in a moment an overview of several types of trust. But for now, I think let's take the form of trust that most people typically think of and look at an example of how it could be an effective estate planning tool, but without getting into the weeds of associated tax legislation here. So if you take a discretionary trust as an example, this is a structure where trustees control and manage the assets and any income they produce on behalf of the beneficiaries or for the benefit of the beneficiaries. And they then decide how and when those assets or income are distributed among that either defined list or class of beneficiaries. It can be pretty flexible. This is essentially an alternative to gifting assets outright to individuals, but afforded extra protection compared with that solution. So why would anyone do this? The first key advantage, as I mentioned, is asset protection. Assets held in trust are generally protected from risks such as divorce, bankruptcy, or even just general financial mismanagement by intended beneficiaries if they were to own the assets outright, which can be a major consideration when planning over the long term. Secondly, trusts can offer capital gains tax advantages compared with outright gifts. A gift into a trust can often benefit from CGT holdover relief, which is not available when gifting to an individual or to a company, meaning gains can be deferred rather than being triggered immediately. And funding that upfront CGT can often be really problematic when we're looking at lifetime gifting of any asset other than cash. Thirdly, trusts are useful for multi-generational IHT planning. So whilst the assets going into a discretionary trust might be subject to an entry charge of 20% on any value above the nil rate band, and indeed thereafter a periodic charge of up to 6% every 10 years, again on any value above the nil rate band, these charges can often be managed and mitigated with careful planning. Importantly, assets held in trust sit outside any individual's estate, meaning they're not exposed to the 40% IHT charge on death, which is a crucial advantage, of course. That said, trusts are not a silver bullet for tax efficiency, as a lot of people think they are, but certainly they can provide a very tax efficient tool when used and implemented correctly. They can sometimes be costly to establish and maintain, though not always. And they're certainly not appropriate in every situation. They should always be considered really as part of a well thought through holistic estate plan rather than being used in isolation. So Phil, do you want to talk us through trusts in a little bit more detail?
Yep. Thanks, Alistair. So Alistair has explained why trusts exist. And so let's look at how they're actually used. There's a number of different names of trusts, and it can be quite a confusing world, but I'll try and break them down into the main trust that we see. Discretionary trusts are the most flexible. Trustees can decide who benefits, when, and in what proportions. And this flexibility is really valuable when circumstances change, but it does come with a more complex tax treatment, namely periodic and potentially exit charges as well. Interest in possession trusts are more structured, and they give someone a right to income, often for life, with capital passing to the next generation later. And these are commonly used when income security matters, for example, in second marriage situations. Loan trusts and discounted gift trusts are mainly used for lifetime planning, and they let someone reduce the estate's value while keeping access to capital or income. And these are usually combined with investments rather than just holding static assets. It's important to be realistic, and just to expand upon what Alistair mentioned earlier. Discretionary trusts are often treated like a universal solution, but they're not. From an IHT perspective, they're constrained by the nil rate band, Anything above that can trigger an immediate 20% IHT charge. In practice, discretionary trusts work best up to the nil rate band, either through wills or during lifetime planning if there's unused allowance. But beyond that, the tax cost can outweigh the benefit, and sometimes they can only defer tax instead of reducing it. Ongoing charges and administration are normally fairly modest, but also need to be considered. And where someone has a large portfolio of managed properties, traditionally within the Acuity client holdings, we've got a number of professional portfolio landlords. Trust planning needs to be treated with care because lenders generally aren't particularly keen on properties they've lent against being moved into a trust because it complicates their security and their ability to enforce the loan. So it's just an important point and needs to be factored in when looking at trust-based landlords, when looking at trust-based planning for landlords when there's mortgages involved. So while discretionary trusts are great for control, flexibility and protection, they aren't necessarily a scalable solution for very large estates. And that's why trusts often sit alongside lifetime gifting, corporate structures, business relief planning, or family investment companies to make a larger impact. So want the takeaway to be that trusts aren't good or bad, they're tools to use, and their effectiveness depends on the estate, family dynamics, and comfort with complexity. Used well, they provide structure and protection, but used poorly, and they can create unnecessary tax and administrative headaches. Alistair, I'll pass back to look at family investment companies.
Thanks, Phil. So turning attention to family investment companies, these are becoming increasingly popular. We're seeing a huge influx of questions on these and requests to set them up. So was very keen to explore them here with everyone. At a high level, family investment companies are a relatively simple and flexible way for families to maintain and grow wealth in a potentially inheritance tax efficient manner. It should be said, an FIC is not a distinct separate legal structure. It's just a company with a certain type of share planning, which turns it into or gives it this moniker of family investment company. So whilst FICs do require extremely careful planning, drafting and execution, the IHT planning opportunity they offer is relatively vanilla in the estate planning space. It's certainly not one of the productized solutions that's likely to attract HMRC scrutiny further down the line, as long as it's not implemented in too punchy a way, I should say. Much like lifetime gifting, the IHT efficiency of an FIC ultimately depends on how much value the individual is prepared to give away, and we'll explore that in a bit more detail. But crucially, FICs can minimize upfront CGT, unlike outright gifts of assets, while still passing wealth out of people's estates for IHT purposes. One of the key attractions of an FIC is really its simplicity. They're generally very easy to understand. They're pretty straightforward to operate, and most people, certainly existing business owners, are already familiar with a company structure. So the commercial and governance perspective of them is quite easy to get your head around. Importantly, they allow individuals to retain control over family wealth, whilst whilst passing growth in value of the FIC and its underlying assets and holdings outside of their estate. Structurally, an FIC could be a standalone investment company. It could be the top company of an existing family group, or we could even, it could be implemented in respect of an existing trading company that operates the family trading business. In broad terms, either a new company is set up or an existing company is adapted, and the share capital is divided into different classes. Using a simple parent-child example, and ignoring bare trusts as they may be required for minor children owning shares for simplicity, the parents typically retain a class of so-called freezer shares. These shares may have a capped value and usually carry the majority of the voting rights, meaning the parents continue to control the company or the group. The remaining shares are gifted to the children. These are effectively growth shares. Through careful drafting and robust valuations undertaken, the value of these growth shares at the point of gift can often be justified as being relatively modest, which in turn helps mitigate any upfront CGT exposure, which is a critical planning advantage over an outright gift. Those growth shares then participate in value above a defined growth hurdle. That hurdle might be set at the current value of the company or group, or at a higher level, indeed, if parents want to retain an entitlement to some income or value during their lifetime. It stands to reason that the higher the growth hurdle, the less immediate IHT efficiency is achieved, but the more that upfront CGT is mitigated. The company itself can then be funded in a number of ways, either via the recycling of existing company funds or group funds. It could be funded by the parents through share subscriptions or indeed via loans. Those loans could later be assigned to the children at a later date as well as part of further IHT planning. There's some nuanced CGT rules that need to be considered in that respect, depending on the timing of assigning the loans. But it's certainly something that we've seen implemented. Despite having gifted the growth, as I mentioned, the parents remain in control, both through their voting shares and through their role as directors of the company. That allows them to control investment strategy and distributions. Meanwhile, future growth is accruing outside their estates and instead passing into their children's estates. So overall, NFIC is, I would say, best viewed as a much more of a longer term strategic planning solution. It's certainly not deathbed planning. It's a way, when implemented, as far in advance as possible, of combining control, flexibility, and tax efficiency over time, whilst keeping a relatively simple and easy to understand structure. Now, taking this one step further, a question we're very often asked with FICs is how interest in the FIC can be protected over the long term. Now, at a basic level, shareholder agreements, the FIC and the company's articles can actually effectively restrict transfers of shares outside the family and certainly offer a degree of asset protection. And while helpful, they're not a guarantee and not a complete solution, though, and particularly in scenarios such as divorce, bankruptcy, or indeed, as I mentioned earlier, poor financial decision making. That naturally leads us to consider whether FICs can be combined with trusts, such as discretionary trusts. What we mean by that is rather than children or other descendants holding the FIC shares outright, the shares can instead be held within a trust, with the parents perhaps acting as trustees and the children and wider descendants as beneficiaries. This allows the parents to retain an even greater degree of control over the underlying family wealth, while still achieving the succession planning objectives. Holding the FIC shares within a trust naturally provides significantly enhanced protection, shielding the shares from bankruptcy, divorce, financial mismanagement, and it preserves the integrity of the structure. And it also, from a tax perspective, has to be said, enables multi-generational IHT planning. By placing those growth shares into trust now, families can avoid a situation where the next generation, once in control of the FIC, later has to implement their own perhaps freezer and growth share planning, assuming that such planning is even viable or effective at that point in future. From an IHT perspective, in many cases, the value of the growth shares settled into trust is unlikely to exceed the nil rate band at the outset, so no IHT entry charge at 20% ought to arise. Instead, the trust falls within the relevant property regime. So the primary IHT exposure is going to be the periodic 10-year anniversary charges, capped at 6% and potentially reduced where business property relief applies. For example, where the company is more trading than investment in nature. Importantly, though, upon anyone's death, there's no 40% IHT charge at that point of death. So while introducing a trust certainly does add a layer of complexity to what is otherwise a relatively simple structure in terms of an FIC, it's not complexity for complexity's sake. In practice, it's often actually a relatively modest step to take, and one that can materially enhance protection, control, and long-term tax efficiency. And as a result, it is an approach we actively explore quite often with a number of clients where the family circumstances and objectives support it. Back to you, Phil.
Thanks, Alistair. So looking to pull it all together, when we step back, three themes I think keep coming up. First, and I think this is the most important point to make, there is no single solution. So good IHT planning is almost always layered. Wills, gifts, trusts, business relief investments, corporate structures, insurance, each plays a specific role within that planning exercise. Secondly, timing matters. Starting early, it gives more options. Allowances can be used gradually. Gifts can fall outside of the estate, and more sophisticated structures can become possible. So leaving everything until later, it can force a somewhat more blunt and less flexible suite of decisions that our clients will be faced with. Thirdly, planning isn't a one-off. As Alistair alluded to earlier, tax rules change and change fairly frequently. Asset values change very regularly. Family circumstances all change all the time. So what worked 5 or 10 years ago may now be inefficient or misaligned. And the same can be said for potentially 5 or 10 years henceforth. So good planning isn't about clever tricks. It's about coordination, realism, and keeping plans under regular review. For larger estates, there are bespoke structures beyond the traditional tools that we've spoken about today. When done right, these can transfer value whilst retaining control, which I tend to see as the panacea of estate planning, because there's often a conflict between control and benefits of estate planning. And these kind of solutions, they can actually reduce inheritance tax immediately as well as over time. Now, they require careful coordination between tax, legal, and investment advice. But for some families, they're extremely effective, and that particularly rings true for larger estates. And this highlights why IHT planning has to be bespoke rather than formulaic. It's not a one-size-fits-all solution. So let's look at the next steps on the next slide. So the best starting point is to review what is already in place. And that means looking at wills, investments, trust arrangements, asset ownership, existing life cover, and how allowances and reliefs are being used, have been used, or are not being used. And often the biggest gains come from fixing basic structural issues rather than introducing something entirely new. Next, it's really important to identify risk, and that risk can be unnecessary inheritance tax exposure, lack of liquidity within estates, outdated documents or arrangements that no longer reflect how the family wants the wealth to pass. IHT planning can be incredibly effective, but mistakes are hard to undo. Coordinated legal, tax, and financial advice is essential. Alistair and I, along with our wider teams in certainly financial planning and the tax teams, would be very happy to talk through how any of these ideas might apply to your own situations and what a joined up efficient planning exercise could look like in practice. Inheritance tax is very, very topical at the moment. Those that can remember the budget before Christmas, there was a lot of pre-budget speculation about fairly significant and potentially negative changes to the IHT regime. And while those changes didn't actually materialise in the budget itself, they were clearly under consideration, and the overall direction of travel is, I think, becoming quite clear. So, as we mentioned at the start, a large part of our work is now helping individuals and families address their IHT exposure, and we're always happy for others to benefit from that experience. And we hope today's session gives you a clear view of how proactive planning can safeguard your wealth and your family's future. So thank you very much for your time today. I think we're going to look at some questions that were sent in earlier, Alistair.
Yes, we have had a few in, so thank you to everyone for sending those. Phil, we'll just divvy these up as we go through. So the first question is, we've had one around how the 7-year rule applies in respect of jointly owned assets, for example, where one donor perhaps dies before the other. So when we think about jointly owned assets, I think we're often thinking about things like joint tenants versus tenants in common, and really the outcome depends on whether there is a separate, legally quantifiable share of the underlying asset, or if they are effectively jointly owned as joint tenants. Assuming there is actually a separate share that passes through a will or is separately giftable, then, i.e. something that doesn't pass through the rules of survivorship, then it's the share of that asset that is gifted separately by each donor. So each donor effectively has their nil rate band, their residence nil rate band, and their own 7-year clock where that's a potentially exempt transfer. So assuming they survive 7 years, then that does pass out of their estate. So hopefully that answers that one. We've had another question on the concept of making loans to release funds to grown-up children for things like house improvements or to fund a deposit. It's inherently difficult certainly for my generation, to get on the property ladder. So help from mum and dad can be super helpful. So Phil, maybe you can look at this one.
Yeah,
I mean, are loans sensible in that respect?
So, and it's a really, really good question. It comes up quite a lot because obviously parents want to help children, grandchildren get a step up in life. It goes back to the point I mentioned earlier that there's always a conflict between estate planning and capital protection, because unfortunately the risks of giving children, grandchildren large amounts of money is that as soon as that gift has been made, that then is at risk of the capital risks associated with money, i.e. the main one being future divorce. No one wants to think about that at the time, but it's a reality that needs to be taken into account, and also bankruptcy, remarriage. There's lots of capital risk to holding money, absolutely. The flip side of that is if you do actually provide that capital in the form of a loan, you're not helping the estate planning situation, because the money is owed back to the estate at some point in the future and will be classed as an asset, so it's not leaving the estate. So it's a fine balance, because I absolutely see the benefit and why people would look at a loan scenario, but it has to be countered with the capital risks that are associated with giving money outright versus the inheritance tax benefit of making it through a loan. There are ways in which clever documents and agreements can be written that potentially can go some ways to deal with mitigating those different risks, but it needs to be very, very well thought out. And it's the person that asked that question is not alone in asking that question. It's one that comes up frequently when we're looking at gifting strategies.
Perfect, thank you. More than one question has come in asking specifically about how IHT applies to chattels. An example of a car collection was given, and indeed multiple questions also around undrawn down pension funds, whether to draw them, pay the tax, and spend the money. In terms of chattels, broadly speaking, something like a car collection, just to address that one, that is going to form part of a chargeable estate. So, and it's inherently illiquid. So thinking about how the IHT will be funded on that is certainly worth factoring in. In terms of pension funds, feel like that's not really it's, just an IHT question. It's a question of what income does someone want in retirement? What would they be? Is it worth incurring that that tax to be able to spend it? It kind of goes without saying that if you draw down on your pension fund in excess of what you otherwise might do, pay the extra tax, but then use that tax to buy assets that are just going to form part of your chargeable estate, that is inherently inefficient from an IHT perspective. So if we're talking about spending it and losing it and enjoying oneself, then yeah, sure, that's not purely an IHT decision, but it certainly can be advisable. What doesn't make so much sense, as I say, is buying chargeable assets with post-tax pension drawdown funds. And Phil, to kick one back to you, we've had a question around whether specialist advice would be recommended if someone's estate is more than 2 million. So with a mix of property and company assets, the 2 million figure will have come from the notion of the tapering of the residence nil rate band, so above 2.35 million effectively being eroded away. What do you think?
Yeah, it's a significant figure, and I would say absolutely an estate over 2 million, because it's also the estate growth in the future. So if it's over 2 million now, and that's unlikely to reduce in the future, it's more likely to increase. So as Alistair mentioned, the standard residential nil rate band is £175,000 per person, which adds on to the normal nil rate band of 325 per person, which gives individuals £1 million, couples £1 million worth of inheritance tax nil rate band if they've got a main residence and they've got direct descendants. So what happens for estates above a £2 million level is that there is an erosion of the nil rate band, and it's £1 of residential nil rate band lost for every £2 of estate above the value of 2 million. So from 2 million to 2.35 million, there's an erosion, and above 2.35 million, the residential nil rate band completely disappears. So absolutely, estates that are valued at £2 million or above would benefit from specialist advice to look at methods to mitigate the change of that residential nil rate band, because much as it's not potentially the most significant of increases to a nil rate band, it is obviously something that is useful to keep rather than to lose. And if that can be achieved via a sensible planning approach, we would always advocate that.
Perfect. I had another question around a scenario where two rented properties are owned 50-50 by what sounds like the same two individuals, and whether or not it would make sense to swap those interests over such that one person owns one property outright and the other owns the other outright. So CGT needs to be considered here, because no rollover relief is going to be available, assuming they're investment property business assets. So the CGT upon the gifting effectively of those properties, to the extent there is a gain over the base cost, should be considered and weighed up as to whether that's worthwhile. It's difficult to see IHT wise what is achieved by that, especially if the properties are roughly the same value. It's possible that perhaps diverting income to a taxpayer with a lower marginal tax rate might be in point here. If one property yields more income than the other, then it might make sense for the person with the lower marginal tax rate to own that property that yields more income. But overall, it feels like quite a contrived scenario, quite cumbersome, that certainly isn't achieving that much from an IHT perspective. We've had another question, which is a really good one. It comes up an awful lot. This question actually is probably, in our tax team, is the most common question alongside, should I move to the UAE? And it's around whether or not to purchase land or property through a company from an IHT perspective. The answer is that every case is different, and we'd need to, we'd encourage people to come forward to us with some specific facts to help us support people in weighing this up. But broadly speaking, the decision is likely fairly neutral for IHT. And that's because the value of the shares in the company owning any such assets are likely going to be essentially the same value as the underlying assets themselves, albeit as we were talking about with family investment companies, we can then do some planning if assets are, once already, once they're in a company structure, we can do some planning with the share structure to start transferring some value outside of people's chargeable estates in a CGT efficient manner as well. But really, other taxes are normally the driver here. So if we're talking about property, there can be higher SDLT charges if we're acquiring through a company. Even from a non-tax perspective, if we're looking to mortgage mortgage the purchase, the mortgage can be sometimes more difficult to get in a company structure, and it can end up being more expensive. And then what about ongoing taxation? So supposing we've got, we're earning money from that land, we're earning money from that property or those other assets. If those assets are held in a company and those funds are recycled, then it stands to reason that's a better option than owning the assets individually, because the corporation tax rate up to 25% is likely to be lower than someone's marginal tax rate of 40 or indeed 45%. However, if someone is essentially living a kind of hand-to-mouth type existence with the income from those assets and wants access to all that income, the double taxation arising from corporation tax and then tax on dividends likely means that it's better to own the assets individually. But as I say, it's useful to put actual numbers to this and model out a scenario, which we're more than happy to do if people would like to come speak to us. Related to that, another common question is whether to transfer property already owned individually and into a company and to make that company a family investment company. Now, as I was saying before, once the property is in the company, there are definitely more IHT planning opportunities available. It's relatively simple to give away shares of companies. It can be difficult to give away shares of assets themselves, just from a practical perspective. But this needs to be weighed up. It's something that we explore often with clients, using proper calculations, putting actual numbers to it, because we really have to weigh up in that scenario the upfront costs of getting the property, but maybe it's a second home or a holiday home or an investment property, into the company. There's upfront CGT, there's upfront stamp duty, land tax, SDLT to think about. There are long-term IHT benefits, so it's a case of weighing those up and determining essentially what the payback period is of incurring those upfront charges, weighed up against the longer-term IHT benefits. We've had, I think the other questions that we've had are probably best left for us to follow up individually with the people who've asked them. We can see who've asked them or who's asked those questions, so we will certainly follow up with some answers and chat to you individually. They're just quite long and quite nuanced. What I would say is one of them is in the theme of funds being locked up in an estate. So the estate having illiquid assets, it being inherently difficult to fund any IHT. It's worth noting that HMRC are often open, and it's possible to agree instalment plans of up to 10 years to pay off IHT bills. So it's not necessarily as simple as HMRC compelling you to sell any assets, to the extent that the assets are even sellable, but we'll happily explore that with people as needed. So Phil, I think that brings us to the end of the questions for now. So we'll probably wrap it up there.
Yep. Yeah, I think that's that's all that we can answer for today. If anyone's got any other questions, just please let us know. Happy to help. And again, thank you for spending some time with us this afternoon. I hope it's been a useful exercise for you.